Well, hello, everyone. Today is going to be a big day. Today is going to be interest rate liftoff day, and we've got a lot to prepare for and talk about once we get the new summary of economic projections, in addition to Jerome Powell's live testimony in front of reporters, as well as his Q&A session, which will all begin in about 40 minutes. In 10 minutes, we are going to get the new summary of economic projections. So we're going to go through some baselines. First, we're going to compare expectations that I have to what markets have, and then we'll compare it to what's actually happening. It's obviously a big day, and in case you're wondering why I am wearing this beautiful chef's coat, it's because there's a coupon code expiring March 25th, linked down below, called Kev's Kitchen for the programs on building your wealth in those daily private live streams with me. All right, let's talk about the projections that we have. So, first of all, this is the last summary of economic projections that we got December 15th. It's been a while. So we're going to get a new summary of economic projections, the SEP, today. And what I've done is I've kind of written down some numbers that I believe we might see some of these changes head towards. So we're going to look at the median and the range. Median, I'm thinking we're going to see a revision downward in GDP, somewhere between probably like 3.5. Anything less than 3 is going to be a little bit more concerning. If we start getting numbers really low, like a 1 or 2, then that's going to create more of those stagflationary recession fears, right? We don't want that. The unemployment rate, we expect this to sit at 3.5. We'll see what happens with the Fed's expectations for inflation. I expect that these will move up, although I don't think this is going to be much of a big mover here. We're already seeing the 10-year Treasury yield move up, by the way. It's almost at 2.2%. The biggest thing is going to be this bottom section here. I'm expecting them to come in at about 1.6 for what they think rates will be by the end of 2022. If they come in with something like 2 to 2.25%, that's going to be a little bit of a shocker to markets. Now, I'm going to take an orange color here, and I'm going to tell you what the projections are for the from Bloomberg here. So the projections from Bloomberg would be a GDP of 3.6. So I was pretty close with that 3.5, not so much with that 3.0. The PCE, we're thinking potentially a move up, or Bloomberg is potentially a move all the way up to 5. Let me get that number right here. 6 year over year, maybe 6.1 by the end of the year, probably 5. Maybe move that PCE up to 5. That's the Bloomberg estimate here. And do we have any forecast here on Fed funds at the end? Yes, we do. Bloomberg's really close to me, 1.55. That's wild. Okay, that's really cool. So I'm pretty much in line here with Bloomberg, but in orange, just to recap this, orange right here on the side, these are the expectations from Bloomberg economists, about 50 of them. The red are sort of my expectations, and then in terms of which I threw 4.5 in there for inflation. So we'll see. And then in terms of what actually ends up happening will be the Fed. If we get numbers that are closer to the blue numbers, that's going to be a little bit more of a pain shock. And so we don't want that. Now, if we look at a little bit more broadly at just what the markets are doing right now, obviously markets the last probably 36 hours have been in a little bit of a rally mode. And this is expected because I really believe there's a high likelihood that if we just meet expectations here with the Fed, we're not getting a rug pull, and we're really licensing the market to potentially relax, just chill out. We've got all of the negative catalysts mostly priced in at this point. War, recession, stagflation, high inflation. The next CPI report for next month is already priced in. If anything, it's probably priced in worse than we actually expect. And that's because we've already seen commodity prices start rotating down. I mean, look at this. You've got Brent at $98 a barrel. You've got the 10-year Treasury running up to 2.2. This is still a bargain, folks. I believe that the 10-year Treasury will probably run up to 3%, and that's when you're probably going to start seeing those real estate pressures as well. Because, see, with the real estate mortgage rates, the 30-year mortgage tends to trend along with the 10-year Treasury. And so the more we see this 10-year Treasury go up, the more I expect some pain coming to real estate. I don't think we're going to see like a 2008 kind of recession with real estate where we see a 30-40% decline in prices. But I wouldn't be surprised to see a 5 to 15% decline in real estate prices, at least in the short term. Jerome Powell himself has mentioned that, and I expect him to reiterate that today, that he expects his interest rate actions to ultimately cool the housing market. Now, something else to remember that Jerome Powell told us in his testimony a couple of weeks ago was that he expects the rate hike cycle now to be very much like that of the early part of the century, which the early part of this century would be the 2004 rate hike cycle. And if you don't remember, that's okay. I'll tell you, there were 17 increases of 25 basis points in a row. If we had 17 increases in a row, which if we had something similar to that, if we had 17 increases in a row, we would be, I believe, 4.25. Let me quickly just do the math to check. We're at 0 now. So the lower bound at 17 increases, would be 4.25. So that would take us all the way to about a 4.25 rate. And the 17 increases would take a while, probably take about through the end of 2023 to actually happen. But of course, we could end up seeing the Federal Reserve U-turn and start taking some meetings off and not hike every single meeting in the event that inflation numbers actually start inflecting down. Which, if we look at some of the data that we've had recently, we know that the Bureau of Labor Statistics has released a plethora of information here recently, and even the Commerce Department today, that gives us some cause for, in my opinion, relief. For example, we're not seeing right now that wage price spiral. The last labor report showed us a 0% month-over-month growth in wages, which not so good for workers, but in terms of avoiding a wage price spiral, this is actually a good thing. We saw PPI, core PPI, came in lower than expected, which is a good thing. We know that core CPI is coming in at a much lower rate, about 0.6% month over month, so about 7.2% annualized, which is lower than that headline 7.9. We expect that headline number to be even larger next month, maybe as high as 8.5% to 9%, depending on how these oil prices, how long they actually end up staying up. So far, we're starting to see that kind of collapse in commodities again, which we expected, right? A couple of weeks ago, I think you might remember, if you watch the channel regularly, I was regularly saying, hey, you should have some trailing stops for wheat and oil and energy price if you're in them, because high commodity prices last short term because of fear, and fears can tend to evaporate very quickly because we quickly become used to our new reality. Those fears go away and then prices come down. So not a surprise at all that we saw those prices come down. But again, so when you look at CPI, PPI, and wage price spiral, we're actually starting to see some early signs of positivity here, which is good. And if you look at the Commerce Department's retail report this morning, if you look at the sort of the critical core of the retail sales data on the video that I did this morning, you can watch that video. We came in, we were expecting retail sales to go up 0.4% in that category. They actually came in at minus 1.2%. Once you take out food, building materials, gas, and autos. Once you take out those four sections, I mean, spending is going down, led primarily by e-commerce. And that's a good thing because it helps eventually create disinflation. The less demand you have, the more disinflation you create. So that's going to be something we're probably going to expect to hear Jerome Powell talk about. I would certainly be hunting for Jerome Powell to talk about these three things. Make sure he's paying attention to these. I imagine he is. I'd be curious to see him chime in on retail sales. Housing market, I think, is going to be a big deal. And then certainly this potential for the 2004 style 25 basis point hikes in a row will be very interesting. Though, again, Jay Powell's probably going to tell us, hey, we're just going to be data dependent. We're going to start here with the 25 basis point liftoff. We'll take it from there. And then we'll just be data dependent. They're going to be very patient here. So they're not going to give us a big roadmap. As long as we don't get rug pulled here, I'm bullish, and I'm not expecting a rug pull at all. I don't think you should either, but who knows? Take a look just a moment here at the SPY. Look at that perfect bounce there off of the 430, both in the pre-market there, not as perfect in the pre-market, but also just now in the last hour here, had a nice little bounce there right off that 430. And this is one of the things we talked about in the course member live stream this morning, is that I was very much expecting that prices would potentially fall going into the meeting, even though we had a very strong retail buy, the dip movement this morning. And of course, a lot of positivity out of the Chinese stocks because of, well, no surprise, the Communist Party's intervention, suggesting, don't worry, we still want to go to the moon. I don't know why I sounded German there. But, and then of course we did have that earthquake. I think it was like 60 kilometers underneath the sea. Is wild. 7.3, nowhere near that 8.9 we saw with that last Fukushima disaster. So far, no evidence of elevated radiation levels, which is very, very good. We do not want to see elevated radiation levels. So we are now sitting. Actually, we should pretty much right now have the new SEP. Okay, we have, let's see. Fed expects inflation to return to 2% objective. Fed raises key overnight rate to 0.25%, so we got our first hike. Bullard was in favor of raising 50 basis points this meeting. The vote was 8-1, so they did not have a unanimous vote. 8-1, St. Louis Fed President Bullard dissenting. Bullard wanted to do the 50 basis point hike, but 8 of the others said no go, that they stuck with the 25 basis point hike, so we got the 25 basis point hike we expected. Fed expects inflation to return to 2%. Labor market to remain strong. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, broader price pressures. Fed says invasion of Ukraine by Russia is causing tremendous human and economic hardship. Implications for U.S. economy remain highly uncertain, but in near term, invasion and related events likely to create additional upward pressure on inflation and weigh on economic activity. So weighing on economic activity is actually something that towards the second half of the year will likely bring inflation down, right? Fed's website's down right now, but don't worry, I've got other sources here. 11 of 16 policymakers see the Fed funds rate above 2.4% neutral rate by the end of 2023. Fed expects to begin reducing holdings of treasuries and agency-backed mortgages at a coming meeting. Okay, so no clarity on that yet. And a little bounce on the rates on reverse repos. That's fine. I want to get the SEP. We do not have that yet, but this gives us a little bit of a summary here. I've never seen the Federal Reserve's website this freaking broken. But that's okay. We'll get the SEP in just a moment. Oh, here we go. All right, good. So again, we are up 0.25% as we expected, and it was done. We were actually expecting a unanimous vote on this one. So getting Bullard throwing in that no vote was a little bit of a surprise. The SEP is not posted yet. Oh, no, here it is. I got it now. Okay, it's loading. Give it 1 second here for the SEP. Come on. Economic projections are the things that we want. Remember, Jerome Powell did tell us that he was expecting to revise these, but this service is unavailable. This is ridiculous. They should probably cache their website or something or get some Cloudflare or something in here. You are seeing the S&P right now move a little bit below that support level for a moment. It briefly dropped below that support level there. Did people really expect that the Fed was not going to raise rates today? I don't know. Waiting to get that SEP here. It looks like it's almost fully loaded. Again, 8-1 vote here with Bullard going for that 50 basis point hike. Not getting it, obviously. This is the first time in a while we haven't had a unanimous move by the Federal Reserve. Not a surprise that Bullard, it was the one who voted for the 50. He's the one who's been coming out talking about wanting that 1% hike for a while. So really highly unsurprising here. So a lot of volatility right now. You can see it here on SPY, sort of just bouncing around. The market's a little bit unsure which direction to go. It looks like kind of trying to pull down a little bit. I think everybody in the world right now is trying to load this summary of economic projections, and we're about 80% of the way there. So let me see if Bloom already has it. They might. Okay, Fed has lowered its median understanding of long-run policy rate is now 2.375%, not 2.5. Median dot plot forecast for Fed funds rate at the end of 2024 is 2.75. So that's an overshoot. Okay. Still waiting for SEP here. Inflation forecast 4.3% for the end of the year. That's definitely more realistic, but higher than expected. Quarter-point rate hike as promised. That was no surprise. Fed's expecting 3.5% unemployment at the end of 2022 and 2023. This is something that we had talked about as well, that in the summary of economic projections, they usually leave it at a floor of 3.5, that they don't go below that. All right, finally got it. Jeez, that was crazy. All right, here we go. So this is the SEP. They came in at core PC 2.6. Are you kidding me? Okay, but then there's 2022. Oh, we lost the 2021 column. Okay, there we go. 4.1 is where they came in here with this with the PCE for core. Headline 4.3 at the end of the year. Oh, they went with the 2. Oh no, that's what I was saying would be bad. Oh, that's not so ideal. Hold on a sec. Let me put this in so where I can mark it up. Oh, they really pushed GDP down. That was not what was expected. So that's going to be a little bit of an ouchie wouchie. Take a look at this. So this was the last SEP here, right? And remember what I wrote, Bloomberg was expecting 3.6. I was expecting either a 3 or 3.5. And I said, if we saw something with a 1 or 2, it was not going to be that great. Unfortunately, folks, look what we got. The Fed really seeing a slowdown here in GDP. Look at that, 2.8% for 2022. And they left 23 and 24 the same, but a big revision down there on GDP for 2022. Don't like that. No surprise here, with the exception of this. Look at this. They actually ticked up the unemployment rate a little bit in 2024. So that's a little odd. Why they're doing that. And PCE, Bloomberg was expecting 5. I wrote down 4.5. They came in at 4.3. So I was closer than Bloomberg. Yes. And then, of course, the Fed funds projections here. Oh, also higher than expected. Remember, Bloomberg was expecting 1.5. I was expecting 1.6. And I said it would be a bad day if we saw something like 2 or 2.25%. Look what we got, folks, 1.9. That's hotter than expected. So this right here is a sad face. This right here is a sad face. And then, honestly, this right here is a sad face. This is not ideal. This is not what we wanted from the summary of economic projection. So I'd say right now this is a worse summary than we were expecting. If we go out to, we should be able to get to the dot plots here. Yeah, here's the dot plot for rate hikes. Let's see what we got over here. So in 2022, oh yeah, you've definitely got a strong median pull right here at about that 1.9%. And this is probably Bullard over here. Look at him call for basically 3% by the end of the year. I mean, this is Paul Volcker, right over here. But definitely going into that 2 to 3% range without a doubt by 2023. What's the median estimate here for 2023? Let's pull that. Median estimate for 2023. Oh yeah, look at that. You got 2.8% right here. But they expect to actually stay relatively stable around there. Let's see the range. Oh yeah, see, look at that crazy range here, 1.4 to 3%. That's a wild range there. But again, probably Bullard being a little hawkish, which is very common of him. This is him. You could pretty much assume that's him right here. But again, the Bloomberg was expecting us to be right about here. I was expecting us to be right about, probably where those lines are right here. And we ended up, unfortunately, right there. So this is another sad face right here, worse than expected. So it does also look like we've got yield spiking a little bit, which is not surprising. You would expect that. We've got bond yields. Yeah, now we've got that 2.2 on the 10-year. This is definitely now pricing in essentially a 25 basis point hike every single meeting. Potentially, honestly, that 1.9. I mean, they've only got 6 meetings here left. They have 7 meetings, including today, in total. So 7 times 0.25. Let's understand this. 7 times 0.25. That's very interesting. Is this the upper bound or the lower bound? They don't tell us. That's quite odd. I would assume this is the lower bound, but 1.75 equals 7 25 BP hikes, right? This right here is pricing in 8 by year end. And that's a problem because that means at some point we're getting that 50 basis point hike. Unless, of course, this is just like, how else are you going to get to that? There's no way. You'd have to have a 50 basis point hike at some point. So that's very odd. And it's unclear whether this Fed funds rate is, I think it might be a mid-range. No, that could be the 7 hikes then. See how last time they had this at 0.1? Remember, the way these rates work is when we're at 0, it's actually a range of 0 to 0.25. And now we're at a range of 0.25 to 0.5. If we get 7 hikes, 7 hikes would put us at a range of 1.75 to 2. So I guess that's not necessary. I guess if they say 1.9, that's more of sort of showing that midpoint there and not necessarily saying 8 by year end, but it's definitely 7. Yeah, so you're definitely looking at 7 here. That GDP forecast or that decline in GDP, I'm not very happy about that. I did not like that one at all, because this is this was my concern, is that they would go dark over here, and we definitely saw this. Of course, I expect that war is pushing things down here a little bit as well, but not ideal. So let's see what else we have here. As far as the statement, probably, I mean, generally the statement itself is not super exciting. So indicators of economic activity and employment have continued to strengthen. Job gains have been strong in recent months. Unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances. This makes sense. The invasion of Ukraine is creating tremendous economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to cause additional upward pressure on inflation and weigh on economic activity. Committee seeks to achieve maximum employment, 2% longer run objective. So they're maintaining this 2% objective here. Previously, there were implications that we might actually see this get revised up. Continue to monitor the implications. The committee would be prepared to adjust if necessary, if new risks emerge, of course. Okay, so yeah, as expected, nothing here at a coming meeting. So no clear drawdown yet in terms of when we would expect to see, our drawdown on the Federal Reserve's balance sheet. But this summary of economic projections, not ideal from a couple angles. Again, the change in GDP here, lower GDP than expected, 2.8%, definitely a lot lower than what the market expected. Market was pricing in a 3.5. So I was thinking either 3 or 3.5 myself. But so seeing a 2.8 is not good. This increase in the unemployment rate, a little odd again. No surprise on the inflation number going up. That's not that big of a deal. They do see that inflation number going down here, which is good. But this leaving really no room for a meeting without a hike this year. And of course, you've got ranges over here. Let's understand these ranges, specifically the unemployment rate. Well, I wonder, see, they always give this outer bound here. Somebody's always voting for 4%. Yeah, that's not too helpful over here. GDP, though, look at the ranges that we had. Oh my gosh, look at that. That's not good at all. So the ranges were as low as 2.1% for GDP for 2022. That's terrible. That's very bad, and something that I alluded to as well in my initial prepare for the Fed video, and even earlier today, that if we got something in that 2 range, that's not good. So that GDP decline, I don't love. No, I don't like that at all. Yeah, SPY's about to be break even. And you've definitely seen quite a few stocks rotate down a little bit here. So market's definitely trying to figure out how to process this. It is a little bit worse than expected. You can see this clear drop here on the QQQ. This is pretty much any stock. I think anything in the risk space is going to show this here. Look at wheat, though. Wheat's still down about 6%. No real movement here on the wheat index, and not a surprise. Gold, let's see if we got any movement here in gold. A little bit of a move up in gold. Do a quick little BTC check here. BTC on the 1 hour. Let's go to 1 minute here. Yeah, BTC doesn't like this at all. So risk assets moving down slightly on the report that we have so far. So we're not seeing a relaxation yet, looking for sort of that floor where that selling pressure is going to stop. It's quite interesting. Yeah, even the Chinese risk assets here, like NEO, rotating back down a little bit. So JPOW does come out in about 15 minutes to start answering questions. And I expect that there'll be a lot of questions about why are we seeing this, why are we seeing what we have here, which is such a low range on GDP forecast, especially since so many people regularly say, oh, but this why would the US GDP be affected? This crisis in Ukraine is a crisis in Ukraine. It's not, well, you get the global velocity of money impact, unfortunately. So and fear leads to less spending. Fear leads to more savings. So the Fed's, I think, properly pricing in that lower economic growth, which is not going to be great for earnings of a lot of different companies, the exception, of course, those the companies that do well during inflationary times. Companies doing well during inflationary times are going to be those with substantial pricing power. Now, that doesn't mean that their multiples won't compress, which is a problem. But companies that'll generally do well, though, of course, would be something like Tesla does very well, but its multiple still compresses, right? So the premium people are willing to pay for Tesla goes down, even though Tesla's revenue might go up due to inflation. Right now, we're testing that 426 line on the SPY. Looks like we just bounced off the 426 line on the SPY. That could be a sign that just some of the excitement of the day is escaping, and that maybe we're going to bounce off of this here. If we break through this, we're probably going to be right back to 420, which is not so ideal. That's right back to our 0% fib line. And earlier we were getting rejected by the 23.6% fib line. So it really tells us that the market was very tenuous going into this meeting here, sitting between the 23 fib and the 430 line on SPY. And so getting a little bit of hope right here, which we've had before, but we'll see if the market's now fully digested what we have here in the summary of economic projections or not. Let's go through some more of the documents that we have here. See what else, what other resources the Fed gave us. So this is the change in real GDP. Again, not happy about what we got here. This was substantially lower than expected. And so we'll see what the actual ends up being here. This push up in the unemployment rate, I don't know if it's something that is going to be worth paying attention to right now. Obviously, the dot plot came in more aggressively than expected. So a little bit more of a hawkish Fed here overall. Distribution of the GDP ranges. Yeah, so take a look at this. So the March projections are these boxes here. And this is where you got that distribution of GDP. So you could see a lot of folks right here. Actually, the only reason you had some weight up here is because it looks like you had about 6 folks push for about that 3% range on GDP. But if you add up the bottom over here, look at this section over here. I mean, that's 1 plus, that's 5 total, plus about 3, that's 8. You got about 8 votes right here. Roughly, so I'm reading that right, roughly somewhere around 8. Yeah, I'd say about 8 votes right here for quite a low GDP. So I don't love that. Look at this perfect bounce, folks, right here. Look at that freaking perfect bounce off of that 426 line. Gino, you've seen this, you've watched this channel for a while, and that line has not moved in many months, just because it works so well. Of course, it's the minute chart, so it is what it is. But I mean, you could clearly see when we got rejected here at 23, it was a sign the market was going to be tenuous about this. I was expecting this drop into the meeting, but I will say this came a little bit as a surprise. But so did the results on the this forecast here. I was not expecting them to actually come in under 3%, and I even said if we get something under 3%, it's not going to be good. So I don't like that. Forecast uncertainty. Okay, going through the rest over here. No, this is nothing special. Nothing else really special to see here. Let's go back to the table for a moment and just look at 2023, their expectations here for 23. We spent a lot of time on 2022, and Jay Powell obviously comes out to speak in about 12 minutes. But let's see what we've got here. You have the 2023 projection of GDP to be around 2.2%, 2% in the longer, well, in 2024, and then 1.8 in the longer run. That's pretty slow growth. When you get these slower GDP measures, this is oftentimes where you actually see, folks ultimately invest in tech companies because they're trying to get growth. And tech and innovation is what tends to do well in these low GDP eras here. It's just that stagflationary fear that we want to watch for, and I don't like that 2.8. But again, we'll see. Looking at the ranges here. Let's look at the ranges here for the Fed funds. This was wild, the fact that you got somebody here at 3.1. But looking here at the next 2 years, so really 2023 and 2024, it really wouldn't be a shocker to see the rate be somewhere around 2.8 to 3% at the Fed. And this is actually going to be larger than a higher Fed funds rate than what we had in 2018. Let's look at what we capped out at 2015. I want to say it was 2.5 Fed funds rate. By the way, so far, 1 death reported and 69 injuries after the Japanese earthquake. Okay, so take a look here at the FOMC Fed funds rate. This is what we really want to look at here is what happened in 2018. So let's just zoom in to 2018. There we go. Yeah, look at that. We couldn't even make it to 2.5 on the lower bound. So, in fact, let me just edit the graph here. Let me see. Can I just get the lower bound? No, not on this. Okay, fine. That's fine. We'll just leave it as this. It doesn't matter so much. But we couldn't break 2.5% here. And what you actually have in this report is a suggestion that we are going to go higher than we did in 2018 and 19. So that's worth noting. The max of, I'll say 18 was just sub 2.5%. And now the projections are for a higher rate than we had in 2018. So this sort of reiterates in my opinion, the call for patience in the market, that this isn't the kind of market that we really have to rush into, that there are going to be plenty of catalysts that keep this market lidded for a while. It's going to be quite difficult, I expect, for the market to get anywhere near those all-time highs that we had at the beginning of the year. I honestly wouldn't be surprised to see the NASDAQ or certainly the SPY turn negative for 2022 when we come to the close. But take a look at this here. So we capped out at 404 on QQQ this year. And we're down right now about a little less than 20%. So if we go current number 332 divided by 404, that brings us down about 17.8% on the NASDAQ that we're down right now. Of course, we had our death cross already, which oftentimes can actually be bullish when you see a death cross. And of course, you can see how we keep trending down on this fib. The trend is pretty disgusting right now. Powell coming out in about 7 minutes, by the way. He's usually on time, which is great. And yeah, let's take a look here on the 1 minute chart. Yeah, really struggling to try to get any kind of excitement here in the market. Doesn't surprise me. You still have a lot of companies doing quite well today. If you look, for example, at Trade Desk or a firm, a lot of companies that have recently had sell-offs, Chinese companies, you still have green here. So the market's not so upset, but it certainly got more bad news so far than it got good news. The 10-year Treasury yield is also skyrocketing. I mean, it's at like 2.24% right now. I am short Treasuries. That's the only thing I'm short right now on. Of course, course members could always see every single move that I make when I make it, and get sort of a read on my portfolio at any time they want. If you haven't yet, check out that coupon code Kev's Kitchen link down below for the programs. The price will be going up on March 25th, and the price does go up over time. I know sometimes people are like, "Oh, Kevin, it seems like there's often a coupon." That is true, but the price goes up. So if you wait 3 months, it might cost another $75 to $100 or so, and that's because I'm constantly adding value and content to it. And so a quick shout out to Philip, Murdad, Christine, Sram. May have butchered that one. Sorry about that. William, Matt, Emmanuel, Mohammed, Jamie, Matthew, welcome. Looks like, Matthew. We've got 2 Matthews here. A Matthew that joined the Stocks and Psychology of Money, and then another Matthew who joined the real estate investing. And William joined real estate agent sales. And looks like the rest of you all for Stocks and Psychology of Money. All right. So, but anyway, this right here, the TLT, this is what you could go short on. Now, I will say something crazy. If you think that rates are going to keep going up to like 3% or something like that, we'll say something crazy. When I went short on TLT, JP Morgan told me that my borrow rate, because usually you pay somewhere between 3 to 8% to short a stock. If something's hard to borrow, like an AMC used to be, you could be paying like 20, 30% for an annual rate. to short something. When I went to short TLT around like 139, 140 or whatever, they were actually paying me to short it. They like I'm getting paid 0.58% to short it. So it's a negative borrow rate, which is quite odd. But whatever. Don't really understand how manipulated the markets can be like that, but oh well. Of course, again, the flyers today being the Chinese sector, and it really goes to show you how manipulated the market is. Remember, though, with these Chinese stocks, that a lot of individuals are buying the ADR shares. Like you and I, as retail investors, we don't have access to just go start trading in the Shanghai or Hong Kong stock exchanges. So we buy the ADRs, the American Depository Receipts. Yeah, well, these are substantially more risky than investing in the market over there, because if for whatever reason these got delisted, the liquidity of these would substantially plummet. But seeing these sort of fluctuations shows you just how strong that Chinese Communist Party is, and they want to be right. You know, they don't want democracy to win. They don't want capitalism to win. So it's not surprising, or I should say, yeah, it's not surprising to see them come out with support against all of the original, tech crackdowns and regulatory crackdowns they had. Markets also had a little bit of a boost yesterday when Raskin dropped out for the Fed position. She was seen as somebody who was more of a, someone who really wanted to go heavy into banking regulation and, excuse me, and climate change research at the Federal Reserve. So markets were reacted positively to her getting blocked by Republicans. Jay Powell comes out in about 3 minutes. Excuse me. So we'll see that. All right. So let's see here. All right, Faded Polo. It was nice knowing you. You're gone. Bunch of. Want to come in here and just hate? You can go. All right. So you can leave those comments publicly in the free sections. So let's see here. Jay Powell comes out 2.5 minutes. Again, if you're just now joining, we have some bad news. GDP projections. If you're just now joining, GDP projections coming in, unfortunately, lower than the market expected. Unemployment showing a weird tick up in 2024, and PCE coming in roughly as expected, but really that Fed funds rate coming in hotter than expected. So Fed funds rate hotter than expected, GDP less than expected. Both of those somewhat stagflationary signals. So not great. Not great. I'm going to use my member chat to say thank you for handling Faded Full. Oh, well, thank you. Look at that. Loving member for 14 months. That's amazing. Thank you. Meet Chef Kevin. There you go. Okay. 90 seconds for J-Pow, folks. Here we go. 10-2 spread. Good question. Let me pull up the 10-2 spread. My hope. Okay. I'm gonna take a guess. I'm gonna guess it may have briefly inflected back down, but I think this morning it probably ran up to 3.5. I'm hoping. Like, if we can get 35 basis point spread, that's good. It may have ticked back down to 32. Let's see it. Oh gosh, it's terrible. It actually went down. It's at a 23 basis point spread. I was very wrong on that guess, because yesterday we were knocking on the door of 30 again. We were at 30. Actually, we were over 30 this morning. Holy smokes, yeah. Here, I'll show you the day chart really quick. One sec. Oh, it's terrible. Yeah, the 10-2 spread did not like this. Look at that, folks. Oh, see, this is what I was thinking is that earlier we were like 32, 33, maybe pushing up to 35. I expected we would get a little bit of a decline, but not all the way down to 23.5 basis points. That's rough. That's a good little drop right there. Yeah, let's look at the SPY. J Powell coming out in just a second here. SPY on the 1 minute. Look at these. Uh-oh. Starting to break that line here. I don't want to see that. That's not ideal. If we start yeah, we're starting to push through that line there. I don't like that. That is not good. All right. Sell some calls. Hedge. All right. Here comes Jay Powell. Let's go.
Here comes Fed Chair Jay Powell.
I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer run value.
And higher than 18.
These projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Q&A. This is the hard part. Here we go.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
Good question.
So I guess I would start by saying that in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong, conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Good. Market likes that.
Thank you. Let's go to Howard at Reuters.
Yeah, bouncing a little bit there.
Chair Powell, I was wondering in the steps you have quite a markdown to GDP from
GDP. Here we go.
8%. I'm wondering how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
Good question.
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain. But you're looking at higher oil prices, higher commodity prices. It'll be So that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
Wow. That is a wonderful defense to that concern. Really good job, Powell.
Trigger you to go faster.
If you believe him.
Rate hikes, ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you,
Thank you for
Michelle,
the
and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up.
In other words, when will you stop saying we're going to wait for the data? Very good question.
And if you don't start to see that, how will you signal it? What will
Yes.
you be looking for, and what will you be looking for over the course of the year?
Questions
Thank you.
are good today.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year,
Okay.
and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally.
6 months.
So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Wow. Okay.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
Boring.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say, if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom-Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a direct result of the Fed's actions?
That's a good question.
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly, base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for, though, is month-by-month inflation coming down.
Yes.
And so it's really it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, financial conditions have already incorporated a significant number of rating.
Check out this picture I drew really quick. Green is what Powell said was the old. Red is what he expects now for inflation. I kind of translated it into a picture.
And I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this, we have an obligation to carry out under the law in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Okay.
Let's go to Neil Irwin at Axios.
Really quick. Just look at this really quick. It's basically a 3 to 4 month delay in the peak. So in other words, if inflation doesn't come down by like June, July, that's when the rug pull happens.
Neil Irwin at Axios. Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes.
Yeah.
I would add, there's also the...
He just said it. 7 rate hikes. He just said it.
people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the SEP, a good number of participants do see more than 7 rate increases this year.
Yeah.
And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that. But I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting. And if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Yeah, I mean, but I expect they're going to wait until June, July to see that month-over-month inflation come down. They'll kick the can down the road on a 50 basis point hike towards the end of the year. Anyone? Dude, they got to get me in here asking questions.
As we wait for Chair Powell to continue his press conference, let's just quickly check on markets with the Dow up about 50 points, and it's really been...
Go back to Powell, Kelly.
We were up more than 200 prior to the decision top of the hour to hike rates.
No.
About a 0.1% gain S&P.
I want to see the awkward pause.
All the talk focused on the bond market,
And
where the 5-year yield has been
I can't give you, I'm not going to try to give you a really specific test for what it would take to do that. But I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation.
I think this is a little delayed, by the way.
Outlook and making a judgment. And we'll be going, each meeting is a live meeting. And if we conclude that it would be appropriate to
yeah, we heard this already.
More quickly, then we'll do so.
And then this is where the tech problem comes up, but I kind of want to watch this happen. What is this? You saw somebody's desktop. This is kind of funny. Like how long is J Powell just poor guy? They haven't fixed it. This is so much more entertaining than going on CNBC. It's like J Powell and I were having a moment. What a champ. Like make a joke or something. I've never seen this before. Oh, he's back.
A plan over the course of this year to raise interest rates steadily and also to run off the balance sheet. We will take the necessary steps to ensure that high inflation does not become entrenched while also supporting a strong labor market. And as I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that you...
I lost you in the middle of the question.
What impact has there been on you? Cut off.
Edward, can you repeat that question?
The impact that given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
Dude,
none whatsoever.
Question. None. Yeah, dumb question, dude. Go fix your internet.
Okay, let's go to Colby Smith at the FT.
Thank you.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct? And to what extent does it alter both the committee's confidence that long-term inflation
service inflation did not go up that much,
the anchor in the coming months, as well as the balance of risk that the Fed may need to raise interest rates further above neutral than indicated in the dot plot? Thank you.
Thank you. So, of course, that's something we're watching report by report, and we noticed it in the last meeting, and it's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening is in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the good side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
Oh, I like this guy.
Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation being above over the 3-year window, the long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Woo.
Right. So if you look, first of all, there is no, you're looking at medians, but understand that there's no, it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy. Basically, at the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very, very tight labor market, tight to an unhealthy level, I would say. So in principle, if you were if let's say that our tools work about as you described, and the idea is we're trying to better align demand and supply, let's just say in the labor market. So it would actually, if you were just moving down the number of job openings so that they were more like 1-to-1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability. With as I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
Okay, let's go to Scott Horsley at NPR.
Thanks, and I apologize if this covers some of the same ground you just talked about, Mr. Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees?
This is a labor force participation question that he's asking. The last two questions have been honestly a little bit boring. So far, I have to say, I'm really impressed with Powell's answers here because I was concerned about that GDP, but he had a great reply to that.
Was that over the course of a long, steady expansion, labor force participation outperformed expectations. Yeah. And that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market. And so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement. That's not something that happens in the aggregate very much. But so that's what was happening. And, more labor force participation is tremendously welcome. And of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time, and people are able to quit their jobs and move to better paying jobs in the same industry or different industry. So it's a really attractive labor market for people. And once, as we get past COVID, well and truly, it becomes an even more attractive one. So we hope that will lead to more labor supply. That's a good thing for the country. It's a good thing for people. And it also will, we think, help relieve some of the wage pressures that do put inflation more at risk.
Right.
That last part we'll have to see whether empirically it works out that way. But in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking.
So that's another way of him saying, hey, we think as labor force participation goes up, it's actually going to reduce or eliminate wage inflation. In other words, prevent that wage price spiral. That's really big.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said, and my apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve is flattened a lot, and even further this today, dollar is up. Is that welcome? And would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works through financial conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level, so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, so it's time to move to a more normal setting of financial conditions, and we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions, that suggests to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we look at a broad range of financial conditions, and of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things. But yes, we need our policy to transmit to the real economy, and it does so through financial conditions, which means as we tighten policy or remove accommodation so that it's at least less accommodative, that broader financial conditions will also be less accommodative.
Okay, old news. Quick shout out to Max, Furcon, and Philip for joining the courses link down below. Look forward to seeing you in the course member live streams.
I understand the broadcast is coming through clearly on www.federalreserve.gov. So you might go there for the audio. And now we'll go to Jean Young.
Well, I like her studio there, wherever that is.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting. And that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing. And we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of I would say this. I don't want to get too much into the details because we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course, it's much sooner in the cycle than last time. But it will look familiar to you. And I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Okay.
Thank you.
Familiar, by the way, is about $90 billion a month in runoff.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? And in other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah. 17 times.
So I want to clear one thing up again, and that is that nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said. And that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework, we can't blame the framework. It was a sudden, unexpected burst of inflation, and then it was the reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So
he's a little defensive, isn't he? He's like,
vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe, but nonetheless, in the base case, there's a pretty broad expectation of strong growth. But inflation is far above our target, and the help we've been expecting, and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the summary.
Yeah, he's over this meeting.
In the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate, and they're sort of equal. But as I said earlier, price stability is an essential goal. In fact, it's a precondition really for achieving the kind of labor market that we want, which is a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were really no imbalances in the economy that threatened the long expansion. The pandemic arrived. It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Okay. Same thing.
Thank you. Let's go to Brian Chung at Yahoo.
Hi, Jerome Powell. Hopefully no tech issues here on this front. Wanted to ask just kind of the broad question about how you are communicating what the Fed's doing here today to the average American who might not be reading the dot plots or understanding what the SCP is. How is the 25 basis point hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices.
The first questions were so good, but these last questions are just sucking.
High inflation takes a toll on everyone, but it's really especially on people who use most of their income to buy essentials like food, housing, and transportation, where, we've all seen charts that show if you're a middle income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier. It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you ask about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question, doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Come on.
Well, that is, yes, indeed. I mean, as I just said, you know, I think we do understand.
Let's literally just ask the same question. You have got to be kidding me. It should just be like they push the red button, you know, Simon Powell, whatever, you know what I mean.
For a very long time and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what very high inflation was like. And, you know, we're strongly committed as a committee to not allowing this higher inflation to become entrenched and to use our tools to bring inflation back down to more normal levels, which our target is 2% inflation. So we will do that. And I just would want people to understand that. But the way we do that is by raising interest rates and by shrinking our balance sheet. And so financial conditions will become at the margin less supportive of various kinds of economic activity. That will slow the economy while also allowing the labor market to remain very strong. And, you know, the good news is the economy and the labor market are quite strong. And that means the economy, we think, can handle interest rate increases.
That would be amazing.
Follow up to that.
They're standing on a drop floor and Jay Powell pushes a button on dumb question.
Trying to avoid a recession. For the consumers out there who are worried about their jobs and a possible recession, what do you say to that?
Better question.
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the world. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or where if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply, and when that happens, prices go up. So we need to use our tools to move supply and demand back in. We don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at The Economist.
Oh, I like that pub.
Thank you, Michelle. Thank you, Chair Powell. Sorry to take you away from inflation for 1 minute. May I ask about the sanctions on Russia, and specifically the freezing of the central bank assets? Of course, that raises a similar risk for other sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency? And in the past couple of weeks, have you had to deliver any kinds of reassurance to other central bankers around the world?
Well, so of course, central bankers around the world are generally very, very in favor of all of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So the administration, the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but they're not. It's not our decisions, so I'm reluctant to comment on sanctions really much because again they're not for us. We have a very specific mandate, and these are really the province of elected governments, as I mentioned. So I'd have to leave it at that. Sorry.
Yeah.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Pelosi? What?
Hi, Chair Powell. Thanks for taking the question. You've been talking a lot about rising wages, which on the one hand is a great thing, but are we possibly seeing the beginning of a wage price spiral?
Woo! Let's go. Good question.
So the way I would say it is this: we first of all, I would agree with the premise that wages moving up is a great thing. You know, that's how the standard of living rises over time, and generally it's driven over long periods by rising productivity. But what we have now, if you look at these, the wage increases that we have, we look at we're blessed with a range of measures of wages that all measure different things. But right now, they're all showing the same thing, which is that the increases, not the levels, but the increases are running at levels that are well above what would be consistent with 2% inflation, our goal, over time. And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question about a wage price spiral is that something that's going to start happening and become entrenched in the system? We don't see that. You can see, for example, in some sectors that got very high wage increases early on, those wage increases look like they may have slowed down to a normal level. But it comes back to, you know, what I'm saying here, which is there's a misalignment of demand and supply, particularly in the labor market, and that is leading to wages moving up at ways they're not consistent with 2% inflation over time. And so we need to use our tools to guide inflation back down to 2%. And that would be in the context of an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy, and the overall economy can as well. But yes, wages are moving up faster than is consistent with 2% inflation. But it's good to see them moving up, but it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's because of this misalignment between supply and demand. We expect to get more labor supply. We did last time. We got more than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID becomes less and less of a factor in many people's lives, something we all wish. So that's how we think about it.
Thank you. And for the last question, we'll go to Don Lee at LA Times.
Hi, Chair Powell. I think you said to the Senate earlier this month that in hindsight, the Fed should have moved earlier. And it sounds like today that you don't think that the Fed is late. And I just wanted to get your clarification on that. And if it is, if you still think that the Fed is behind the curve, how much behind the curve is it?
Right. So we are not. We don't have the luxury of 20/20 hindsight in actually implementing real-time decisions in the world. So, the question is, the right question is, did you make the right decisions based on what you knew at the time? But that's not the question I was answering, which is knowing what you know now. So I think if we knew now, of course, if we knew now that these supply blockages really and the inflation resulting from them in collision with very strong demand, if we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously, it would be, but again, we don't have that luxury. And then but that's a separate question from your other question, which is behind the curve. And I don't have the luxury of looking at it that way. We have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability, in particular, and prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high, and we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can, and then moving beyond that, if that turns out
practicably,
as you can see, it is appropriate in the sense to people's SEPs. They do write down levels of interest rates that are above their estimate of the longer run neutral rate. Mm-hmm. And there's also a range of estimates too, as you will see if you look at the details of the SEP. But Thanks for your question.
All right. That's it.
Okay. Thank you all.
Review time. Woo! That was good. It was actually good. Started out scary. Ended good. I like it. That was good. Let's do a summary. This is fun. I'm happy. I'm bullish. I like this. This is much better than what we had to start with. So we're gonna do a recap here. A quick shout out to Ardit, Forcon, and Max. Thank you so much for enrolling, all three of you, in the Stocks and Psychology of Money group just within the last 10 minutes. Okay, summary time. Here we go. All right. Here we go. Hey everyone, me Kevin here. Let's do a breakdown of exactly what Jerome Powell just said, what we got from the summary of economic projections, what we have in terms of when inflation is expected to go down, how it's going to go down, because Jay Powell gives us kind of an interesting path for how he expects inflation to go down, which is really important because then we can align with that expectation to where if we see month-over-month deviation in that, we know to either go bearish or bullish. Okay, folks, let's get right into it. We'll also get answers on the wage price spiral and a whole lot of other information. This was a very good Fed meeting. Started off a little dirty, though, because we got the SEP. The SEP came in much worse than expected. GDP came in at an estimate of 2.8% for 2022. The Bloomberg estimate was 3.5%. I was guessing between 3 and 3.5. Seeing a 2 in the front was not good. Markets did not like that. In fact, if you see what markets reacted with, when they saw that GDP decline, we started getting fears of stagflation. We saw markets quickly move down here, breaking below some of our support levels here, only to recover later in the meeting. And that's because of Jerome Powell's responses to some of the things that we saw here. The inflation number on the projections here was not something that we thought would be very important to pay attention to anyway. And instead, something that we really wanted to watch for was this right here. The Fed funds rate expectation was 1.9% for the end of the year. Including today, there are 7 meetings left for the rest of the year. That includes the meeting that just concluded. So that means we only have 6 more to go. If every of these 7 meetings results in a 0.25 basis or 0.25% or 25 basis point hike, then we would end up with at an end of the year lower bound interest rate of 1.75 with an upper bound at 2%, and that could align with this 1.9%. Though what was a little shocking was the range of estimates were substantially larger, potentially suggesting that we could end up seeing higher rates, like a 50 basis point hike towards the end of the year. If we see if we don't see inflation come down, you've got pretty much what we're assuming is Bullard over here, who was the only dissenting member during this meeting to raise rates a 1/4 of a point, which obviously we raised rates a 1/4 of a point. That's the headline news, big deal. Bullard was going for a 50 basis point hike. He was the only one. So by a vote of 8-1, we did get a 25 basis point hike. Again, Bloomberg was expecting here something around an estimate of about 1.55. Sorry, this is Bloomberg right here. Bloomberg was expecting 1.55 to be the end of the year rate. I was expecting 1.6 as the end of the year rate. We ended up getting 1.9. So this is where we initially got some of that heartache when we first saw the SEP come out. We're like, oh crap. Less, like higher rates and worse GDP, not good. So the market's reaction initially was very negative. Fortunately, Jay Powell, whether through clever wordsmithing or what, ended up talking his way straight out of the pain because he gave us a lot of clarity. So let's go through exactly what he said. First, regarding rates, okay, we're up 25 basis points. We expect to pretty much raise rates at least the 7 meetings this year. Including this one. So each of the next 6 meetings, we're expecting to raise rates, quote, steadily. And even at one point, Jerome Powell mentioned, 7 rate hikes this year. Now, I don't know if he meant to say that or if he was hypothetically saying that, but he did. Those words did come out of his mouth. And I think that's because, honestly, that's just the baseline expectation right now, that at every single meeting this year, the 6 more to come, we will have a 25 basis point hike. Also, a lot of progress was made on balance sheet reduction. The full plan is expected to be announced in a coming meeting, but they're actually going to give us a lot of guidance in the minutes that come out in about 3 weeks for this meeting in terms of what to expect. He said it would be very familiar to us. Usually we see about a $90 billion per month balance sheet runoff, and that means it would take us somewhere around 15 to 16 months to actually really start constraining the economy because there's so much money floating around in banks and on reverse repo balance sheets, that really it's going to be a while before the balance sheet actually impacts the economy. In my opinion, there's going to be a big lag here of probably a year to a year and a half. The rates are going to matter more for constraining the economy and bringing that inflation down. But it could be as soon as the May meeting that they start reducing the balance sheet, not this time. Regarding GDP, and this was really important because remember that SEP was ugly. Why did it come in at 2.8%? Jerome Powell says it came in at 2.8% because of spillovers from the war, higher oil, and higher commodity prices, and that this is why they assessed a 2.8% GDP. However, he says, let's remember, this is still very strong. He put us back into like historic perspective. He did a really great job here. He says, look, 2.8% is great. We expect it to be like 2.1 and 2% for the years going forward. In fact, you could see exactly that. I'll show you that really quick in the summary of economic projections so you can see that. There you go. Top line number right here. We expect 2.2% in 2023 and 2% in 2024. And he goes back and says, look, if we got a 2.8% print and we weren't, and we didn't have the pandemic, 2.8% would be a great thing. So it shouldn't be seen as a negative that we came in at 2.8, even though that was my initial reaction and so was the market's initial reaction first. Then he was asked, so this was interesting. He says this would have been one of the strongest years, again, had it not been for the pandemic. Then he talks about employment and the wage price spiral. He talks about how labor force participation going up should actually help reduce wage pressures and eliminate the risk of a wage price spiral. There are currently 1.7 job openings for every unemployed person. And he does agree that wages going up is a great thing. He sees wages going up. But he says, this is an important line here. Listen to this one. Quote, increases are consistent with 2% inflation over time. We do not see evidence of a wage price spiral. Huge. Okay, that's really big. That doesn't mean he's right. Numbers could change. Next month, we could go, oh, crap, right? But remember the last BLS labor report came in, it was 0% month-over-month inflation for wages, which not so great for workers, but in terms of the wage price spiral, great. He was very frustrated about people suggesting that the Federal Reserve is behind, that they're falling behind. And he very aggressively replied and said, look, some of our estimates actually put our estimates for interest rate increases above the neutral rate. The neutral rate is 2% to about 2.5%. And what we're seeing on some of these projections is that we could actually end up seeing our interest rates, our Federal Reserve interest rates here. They see the projection, how it says 2.8% there for 2023 and 2024. That is above the neutral rate. And so JPow's like, this is us running ahead. This is us not behind. So obviously a lot of people listening to this are going to say, dude, he's way behind. Because he is, but he got really frustrated about people saying that. And he's like, we're not behind, we're on it. So a little bit of J-Pow anger there. Which, quick note, in case you're wondering why I'm wearing the chef outfit, it's because we've got a special Kevin's Kitchen coupon code down below for the programs on building your wealth. Shout out to those of you getting into the Stocks and Psychology of Money group. You get all my buy-sell alerts, see where I'm moving, how I'm positioning my portfolio. Those of you who got into the wealth course, real estate agent course, and the real estate investing programs, the 10-year treasuries jumping quite a bit, and that's going to create some real estate headwinds. So excited to talk to y'all, course members, about strategizing for that. Okay, moving on with J-Pow here. So what about supply disruptions? Obviously lasting longer than expected, but how is inflation going to be measured now? And this was so beautiful because you've heard me on this channel talk about how there's old inflation, and that's the original COVID shock, the original supply chain disruptions. And then there's the new inflation. And those two have now merged to create this monster of inflation. And so the question is, Jerome Powell, when did you expect inflation to go down originally? And how do you think inflation is going to go down now? This was really interesting. So what I did is I drew a picture to basically show you graphically what he said. So this is that picture right here. Okay, so here's how this works. The green line, let's just say with these little green dates here, was his original expectation. He thought that we would see a peak in March of 2022, that we would hit peak inflation. And then the course is really interesting. He said that he thought inflation would come down, level out for a while, and then towards the end of the year in Q4, going towards December, fall more rapidly. However, because of the new style of inflation, he now appears to be pricing in about a 3 to 4 month delay to the peak. So this actually makes the peak more likely to be around Q3 2022, that would be somewhere around, let's see, we got April, May, June. We've about July, right? Maybe somewhere between July and September for the end. So now, if we look at the same course, he ends up saying that he doesn't believe we're going to see that. We'll see that leveling off maybe between Q3 and Q4, but then that more rapid deceleration in inflation not until the first quarter of 2023, he says. So in other words, he's delayed everything by about 3 to 4 months. What does this mean for you? Well, it means you really have to, watch the month-over-month data. Really, really important, because the year-over-year is going to have, some high comparisons to last year in May, June, July. But the month-over-month data is what you want to watch. But also, you really want to watch this time frame right here: June, July, August, September. That's what you want to pay attention to. Why do you want to pay attention to that time frame? Because we know the next CPI report that comes out for March, April, May, we know all of those reports are going to be high because of war. That's already priced in. The Fed's already looking past that. In other words, the Fed thinks that right now we're doing this. We're still going tick, 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 tick on the roller coaster right over here, right? And so when we get to that peak, or at least Q3 of 2022, if we don't actually hit a peak in Q3, that's probably when the Fed's going to have to be a little bit more aggressive and go for that 50 basis point hike. That's a really, really big takeaway from this Fed meeting. So you really want to sear that image, or like print it out or whatever into your mind, because it's a really big deal for what he just said. So, of course, he mentioned his goal is to promote a long expansion, which is only possible with price stability. He does say it's going to take longer than expected to get inflation back down, but they're going to be very nimble when it comes to the data. Okay, this is not so exciting. Here's more exciting. Recession. He says, in my view, the probability of a recession is not particularly elevated right now. He brushed off questions about the 10-2, did not care about the potential for an inverted yield curve at all. Does not see an increased potential in a recession. Says the labor market is strong, payroll job growth is continuing, household and business balance sheets are very strong. We found out this morning that the average consumer balance sheet is larger by the tune of about $16,600. So we still have excess money in basically our savings accounts or whatever. And Jerome Powell combines all of this data and says, look, we think the economy is set for easily absorbing these potentially 7 rate hikes over the next now set, including today, 7 meetings to come, and no big issues here. Regarding sanctions, he's in favor of the sanctions, but really tried to dodge any kind of political liability there, and so didn't have much for us to say there. But I think if we sum this up, honestly, what did we get here, folks? No rug pull. This is what we were expecting. We were not expecting to get rug pulled. We pretty much got what we expected. We did get a worse estimate for GDP and a little bit higher of an estimate for the Fed funds rate, but we've been expecting 7 straight 25 basis point hikes. So, okay, a little softer GDP. We got what we expected on inflation talk. We now know a time frame for inflation. We know what data they're going to look at. I mean, you can't communicate any more clearly than Jerome Powell did today. There's no rug pull. It shows us that he's not trying to, surprise us or shock and awe us. Bullard is, but Bullard's in the minority. He was the one voting all by himself. Of the other 8 people, like, Bullard, you're nuts. It's like Bullard's trying to do the Bill Ackman, shock and awe, and everybody else is like, you're nuts. Okay, we're gonna wait for that data, July to September. We're gonna be patient with it. We think the economy's capable here. Personally, with the SPY and the QQQ barely off their 0% Fibonacci lines, I'm bullish on this. I like this meeting a lot. I was a little nervous initially when I saw that SEP, but coming out of it, I'm happy about this. Thank you so much for watching. If you want to see exactly what I'm buying, check out those programs linked down below. Thanks so much for watching, folks, and we will see you in the next one. Thanks so much. Bye.